Hello and welcome to the Weekend Investing Daily Byte. The series starts again, 18th of November. We had a small break and the markets didn't budge from their downward move all these days. So we are now answering the question whether recovery or gloomy days are ahead to the best of our ability to speculate and call the markets. My own sense, I will share that, of course, will is somewhat not so gloomy. I think the markets are coming off after a heady rise, and some tempering of the rally was expected at some point. Of course, it's in hindsight easy to say that, but nevertheless, I don't think any calamity has happened for anybody to feel really panicky about the situation. So please do go ahead and subscribe to the channel if you like the content and click on the bell notification as well. Let's see where the markets are. So the markets have retraced back to the election day high top. This was one of the targets of this head and shoulders pattern that you see here. Target was around 23,300 odd. We have basically come there, and this particular top and the pivot here has given some support today to the market. Of course, nobody can say that this is a turning point or anything like that. As you very well know, the first probability of that comes when there's a 2-day high. This one failed. We have to continue to wait for that. The 200 DMA is badly broken. Sorry, the 40 SMA is badly broken, and the larger head and shoulders pattern that got formed, although it is a bit of an irregular pattern, has a target of nearly 21,300, which is the bottom of the election day candle. So election day candle actually, or the week, has become prior importance in terms of its top providing some support likely, and the bottom, of course, is the bottom of the market, because if that breaks, then all bets are off. So this is where the situation is. The date of Maharashtra elections is on Wednesday, 20th, and that is a trading holiday. The results obviously are going to come on 23rd, but there will be exit polls before that, and you know how exit polls cause markets to violently move. So expect some violent moves on Thursday and Friday, or definitely a big gap on Monday, depending upon what those exit polls are and what is the final outcome. The thesis that one wants to hear as a positive news is that government tries to have a good mandate, because that will give a lot of confidence to the market that the current government can continue without any pressures. So if there is a positive outcome for the government, I think the markets will rally. And of course, if there isn't, I don't think that is such a big shock, because that is the expected position in the market right now. So the market has come off. We have given up for about 5.5 months of gain, which is always quite a decent amount of period with zero returns. Of course, market can continue to be in no return territory, no net return territory for long periods of time, as we saw in 2008, we saw in sometime in 2018, then in 2020. So markets could remain in a lackluster mode for a long period of time. So that should be in your accepted psychology, that we may not be making much returns going forward, but then these are shorter term pains in the market. Nifty Junior flat for the day, but has already come off this particular support that we are talking about for Nifty. So Nifty Junior is already down to half of, nearly one third down into the election day candle, and of course is also making all kinds of patterns which look to go downward. So no element of strength as such visible here, except that it had a flat day. Mid caps also a flattish kind of a day, minus 0.18%, but the leg downwards is definitely there. This has also stopped near the election day high, and that's where we are on mid caps. Small caps also very similarly, although small caps are the only sort of index which are still much higher than the election day high, and that support is not yet tested. Although the chart looks nothing exciting from a chart point of view, minus 0.64 on small caps. Bank Nifty also sort of neither here nor there. We are again about at 5 months of zero returns on Bank Nifty at 0.37. The crisis, if I may say so, is likely to happen in banking or interest rates, where the government wants interest rates to cut, the RBI doesn't want interest rates to cut, and the term of the RBI governor is coming to an end. So let's see how that folds out. Will government force somebody in that position to who will toe their line? I don't know. The Fed has also cut two times, once 50 basis points and once 25 basis points. It has not impacted the yield at all. In fact, the yield has gone up dramatically. So inflation fears are very well entrenched in the system. So I don't know if any cuts, etc., can come through. Momentum trends largely declines, even though the market was reasonably flattish, but there was bias towards the downsides. 317 declines to 170 odd advances. The FI selling in previous session was 1800 crores, so the quantum seems to have reduced from 5000 or 4000, 4500 on average towards 2.5 3000 on average, but so is the DII buying also sort of on the back foot. Heat maps extremely poor for IT stocks. So Infosys, TCS hammered almost 3% each. You also had NTPC, Trent, Reliance, Cipla, Dr. Reddy's all moving down. HDFC Bank and State Bank of India were sort of the face saving grace for Nifty, and commodities stocks and metal stocks did quite well. So you had Tata Steel, you also had Vedanta, you had Hindalco do quite well today, as China has proposed taking off subsidies for export, and hence Indian exports may get that slight advantage in terms of pricing. And of course, the pricing of the metal itself has gone up, so aluminium has gone through the roof, and so on. So for Chola Finance, VBL, Vedanta, Indigo, these all did well today in the Nifty Next 50. LTIM, Adani Stocks, JSW Energy, Gas Authority, and other city gas companies also were dramatically down today. Uh, no particular green move within the Nifty Next 50 as well. Metals performing the best at 1.9% today, IT performing the worst at minus 2.3% today. Everything else was between plus and minus 1%. So in nothing sort of a day, but you can see for a week, for a month, and for 3 months also, almost all sectors are now red. So we've had 3 months of poor performance in the market, and it's a price and time correction that is happening. When it turns, nobody knows, but it may be coming close to that. In terms of metal stocks, you had uh, I think this is a mix of the mid cap stocks that moved up, not particularly metals. So Godrej Industries, Nalco, Indiabull Housing, these are the top gainers for the day, and metal index also was trying to find some bottom here. Metal index, you can see, is almost near the bottom of that election day pivotal bottom here right now. Godrej Industries was up 9.8%. So this is trying to find some wind again. After this huge run up it had in August, it had corrected down dramatically and now is coming back. In the longer term picture, Godrej Industries actually looks quite good going forward. So recovery or gloomy days ahead, are there more headwinds than tailwinds? So let's look at some charts. So first and foremost, Nifty has slipped below its 200 DMA, which is never a good sign. Usually you would find that at 200 DMA, a bounce at least would happen. This time that bounce has also not happened and we have closed below the 200 DMA. Maybe it's a false signal and the next couple of sessions we may come back up. If that happens, then we can call it a false signal. But as of now, it seems that the 200 DMA is getting broken. This is the Nifty distance to 200 DMA in the last 10 years. So you can see that several times 200 DMA gets broken, but those are always good times to enter the allocation towards the market, except for extreme situations like COVID or maybe the 2008 GFC. Buying below 200 DMA or at least allocating below 200 DMA is a good activity in the sense that within no time are you above the 200 DMA. So there's, unless it is a big crisis that is happening, the 200 DMA is a reasonably safe place to deploy capital. And right now we've come to the 200 DMA after a while. Well, the last time we did that was in March 2023. So after 18 months, we have returned here. So maybe it's a positive thing going forward. The RSI is also looking down at the lowest of last 12 months. So most indicators are oversold. The number of stocks trading up above 200 DMA has dramatically reduced from 61% to nearly 43%. And on the smaller moving averages also, very few stocks are actually looking up, only 14% on the 20 DMA as well. Foreign portfolio investors remain bearish. So they are continuously selling 23,000 crores so far in 18 days. Last month, of course, was huge at 1,56,000 crores. So it does seem like that the selling is tempering off. It is nowhere near. I mean, even if you assume that this doubles by the end of the month, we'll still be at 46,000 selling, which is a much bigger reduction from October in terms of selling. So maybe going to December, that number may further go down or may even become positive. US yields have been on a upswing. If you recall, this is the point where the 50 basis points cut happened in September, and then a recent 1/4% cut, but that has not stopped the yield. So this is the worrying part, that if yields break out, I mean, how do you control that? The inflation, uh, has not come down, so rate cuts are not happening. Now with inflation high and despite rate cuts, two rate cuts, yield is running up. Maybe the market is trying to tell that yields are not ready to come down as yet. And if really the worst has to happen, then interest rates may have to go up once again. So I don't know what happens here, but this is extremely tricky situation where the Fed is sort of moving out of or running out of the weapons in their toolkit how to manage this. The dollar index strength is amazing. It's gone from 100 to 106 in no time. And you can see this is one of the highest dollar strengths since the last year and a half or so. And then this continues to move up would mean, if this continues to move up would mean, no funds coming towards emerging markets, precious metals, so on and so forth, as the liquidity will continue to flow towards the dollar. Maharashtra and Jharkhand elections are, I think, key pivots or key pivotal moments in the coming few weeks. Maharashtra, of course, this week itself. So this is where, it could turn the tables in case we get a very favorable outcome out of that. That should give a lot of confidence to the market. And we are at a reasonably good support point for that turn to happen. So there is, I would say, decent probability of that happening. Uh, we've sort of remained very, very strong last whatever number of years you may see. And since 2015, we've not had a negative year on Nifty. At least, I mean, it's a green candle every year, which has never happened in the past. So, there has been a sort of you can say, a habit formation that you come to the market and you make money, you will never lose. So that needs to get broken at some point of time for normalcy to get restored. So maybe a year of a flattish nature or some 10-20% down is not such a bad thing for the long term from my point of view. I think expecting that market can keep running up, to the sky is also not sort of the right expectation. So see things in perspective, see things over a period of time. Don't have a short-term view. Um, Unfortunately, as the statistics are pointed out, the average retail investor stays in the market for only 18 months. That is the statistics from MFI. And that is extremely sad because most of them will come near a top, and the next 1.5 years, if there are no returns, then people will move out and come near the next top. So don't do that mistake. Don't stop what you're doing. Don't stop your gradual entry into the market. Think long term. Think that and go back and see what your strategy has done in the last 7 years, 8 years, if you have that data, and see how it has navigated those testing times. And every time you will find that your strategy has navigated it, either superbly or averagely or whatever it may be. But at least giving up when the strategy is not doing well has never been a great you know uh, decision from a investor's point of view. So successful investors are those who get past corrections, and believe me, the current 10 odd percent correction in Nifty is nothing. If you were in the markets in 2008, you would have seen a 70% cut on Nifty. If you were in the markets in COVID times, you have seen a 35% cut in Nifty. And this is Nifty I'm talking about. I'm not even talking about small cap. So have that perspective right, have the context right. 10% is very normal for these kind of buoyant years that we've had. I think if we escape with 10-15% kind of a cut and then we move on, I think it's a great combination to have, that we had some great years and then we had a 10-15% cut and then we moved on. That will be great. So keep sipping. We are on a great, fantastic long-term trajectory, and continue your either SIPs or in lump sums. If you are bringing in invest more kind of situation, that is also fine, but don't skip because you think the market will go down and you'll be able to catch it lower. Don't make that mistake. That mistake has been made millions of times by zillions of investors and nobody benefited out of that. So thank you so much for watching this. Do like and share this video if you like the content. Please share it with your colleagues, friends, family, whoever may be interested in the markets. Maybe they will learn something new, possibly. And do subscribe to the channel. Thanks. Bye.